Thank you. So just actually, I want to survey the audience around to wake people up a little bit after lunch, and also to get a gauge of where the understanding is around halving. So I by show of hands, who in the room understands halving events? So yeah, pretty much everybody in the room, and who actually finds halving events to be a bullish or a positive outcome for price. So okay, a bit fewer hands. But maybe more hands up on stage. So yeah, maybe we can just start with a very brief crash course. Seems like a minority in the room, but what is a halving? When's it happening? Or halvening, I guess some people like to call it. And why is it so important, both for the network, but also for Bitcoin and Bitcoin price? Artem, maybe you can kick us off there.
Yeah, sure. For those who don't know me, my name is Artem Bespaloff. I'm founder and CEO of Asic Jungle, one of the largest ASIC brokerage firms by number of units sold. Also GP of HX Group Capital. It's an opportunistic Bitcoin mining fund that mines with the intention of having in and out strategy of the market and implementing portfolio diversification of operations on a global scale. So to answer Zach's question, in terms of halving, I think it's important for us to see, to understand that if maybe somebody doesn't understand halving necessarily, maybe I will take 30 seconds to explain a bit how the Bitcoin network works. So in the traditional fiat currency system, when you're paying for something, you have a financial intermediary, such as a bank, approving the transaction and verifying on the ledger that the money that you're transferring to someone is actually the money that you have on your account. Bitcoin works a bit more democratically in the way that if Zach was to give me $20 or I was to give Zach $20, you guys would be the ones watching the transaction happen and noting on the ledger. And as an incentive to doing that, the Bitcoin network would reward you with a certain amount of Bitcoin that's mined on blocks every 10 minutes, and which quantity is limited. In order to make economical sense of that incentive, the amount of Bitcoin that's allocated per block is divided in half every 4 years. Therefore, right now we're in a cycle where each block is 6.25 Bitcoins, and in April we're going to see another Bitcoin halving, and it's going to be 3.125. What we've seen and what's interesting to see is, and not many hands were raised when, Zach, you asked about what's the impact of each Bitcoin halving on Bitcoin's price. And if you were to take the Bitcoin price cycle and divide it in cycles from halving to halving, you would notice that there is a very interesting pattern that occurs between each halving event. So if you go from excluding 2009 to 2012 for lack of data, but if you go from halving to cycle top, it always takes, usually between 18 to 22 months, and we've seen price increases of between 500 to 7,000%. Cycle top to cycle bottom had a bit less variance and took usually 13 months, and we've seen price decreases of 74%, I believe, on average. And cycle bottom to the next halving, there's always been a little bit of a rally, which we're noticing now. So there is a certain cyclicality element to Bitcoin, and therefore, to add on to the question, I believe we all miners think and see that influence of having to the Bitcoin's price, and we adopt operations regardingly.
So Geoff, just expanding on the link between halving and valuation. I mean, there's always a question in my mind about efficient markets. Efficient market hypothesis says that these are predictable events. These are hard coded. So we know that they're happening. Why would it influence price? Why is it not already priced in? Firstly, and secondly, if that relates to stock versus flow, what's different with each halving event with respect to the kind of impact that it has on the stock versus flow?
Well, it's interesting. There's dynamics that happen in the world, but for whatever reason, every 4 years, the cycle seems to repeat itself. And I think in 2020, we got hit with a double whammy because we had the halving in May, and then a couple months earlier, the world shut down with COVID. And the price just collapsed. Like, everything collapsed in the world at that point. But sure enough, it came around, and these patterns repeat themselves. And like 5.5 months after the halving, the pent-up demand and the adjustment, there's a transition period that takes place. I think the world and adoption is getting better and quicker with these type of things. But generally, about 5.5 months, Bitcoin starts to go, and it goes up. And from a miner perspective, our margins start getting better, the excitement gets there, and for the next 18 months, 15 to 18 months, there's a rally, and we call it the bull run. And that's when the transition has taken place, and the flow and the adoption all picks up, and those are the days that we live for. Those are exciting days. That's when the profit margins are fat. That's when the valuations zoom up, and we have asymmetrical upside when that happens. That's why we're in this mining game, and why I think as investors, you want to get involved with us, and it gets excitement. It gets exciting, and then things cool off. There's this crypto winter that we've been through, and here we are now, and we're setting up for the halving once again.
Jaime, this halving, each halving is half as important as the previous one in terms of the amount of new supply that's coming off of the market. There's a kind of understanding that as miners produce Bitcoin and create all the new Bitcoin that comes into existence, that with each halving, the amount of marginal supply that they have on the market is diminishing and of diminishing importance. But in previous halvings, we haven't necessarily seen that translate to necessarily a huge diminution in the value gain. Would love to hear your perspective on that. I mean, how your model has been to hold the Bitcoin that you mine, but do you think that the supply coming to the market or the reduction in supply coming to the market is going to have less of an influence this time around, or do you still think that it's important in terms of driving or taking selling pressure out of the Bitcoin price?
Yeah, I mean, patterns repeat until they don't. And the last cycle, for those of us that were around, and some of you in the room might remember, there was a lot of talk about the last bull run being the beginning of a super cycle, and that we wouldn't see the big downturn, we wouldn't see the pattern repeat the way it had historically. And in fact, I got a lot of heat from the market when I took on a strategy of starting to diversify the business, of preserving capital and preserving the balance sheet in anticipation of the pattern repeating the way it historically had. And sure enough, it did. And we've seen the corrections that we've seen over the last couple of years. But I think with increasing institutional adoption, Novogratz talked last night about our views on the spot ETF most likely getting approved in advance of the halving, the kind of flows that's going to bring into the marketplace. I think increasingly the signal isn't going to be as clear or clean as it was in the past. We've got a lot more noise in the system, and we very well may not see the pattern repeat going forward. I think we most likely will see it this time. But certainly my strategy it has been to diversify the business, continue to keep Bitcoin on balance sheet, because to your question about supply, ultimately we're all in this because we believe in the long-term growth potential of Bitcoin itself. And so certainly us keeping Bitcoin on balance sheet since we started mining it in 2018, really important to our long-term strategy and where we think ultimately the asset class is going to go.
So before we move on to some of our strategies going forward for dealing with the post-halving world, Taras, would love to round out the discussion and see what your predictions are about this having an influence on particularly price, whether you remain optimistic.
Well, candidly, I think Bitcoin pricing will likely increase with this upcoming halving. I mean, we're seeing a whole bunch of macro trends that are really coming to a head. We're seeing Gary Gensler finally admitting that he's not going to be appealing the ETF appeal process that Grayscale instigated from 2021. So I think that itself is going to lead to a ton of demand that's been pent up from institutional investors looking for the appropriate investment grade vehicle for them to get the exposure. And if you look at the on-chain data analysis that's there, is we have less Bitcoin on public exchanges than we have ever had. And what that means is when these large trillion-dollar asset managers are looking to acquire the underlying spot commodity they need, there's going to be a scarcity of it in the public markets, which will ultimately create the demand profile that will ultimately drive the price up. I personally hold Bitcoin on my balance sheet more so than my wife would personally like, but I do, put my my assets where my mouth is and where I really do think the market's going. And for a lot of folks out there, there's several extremely well-regarded asset managers that themselves have come out and said, Bitcoin wasn't the scam that I thought it was. Ray Dalio admitted that it wasn't. Larry Fink admitted that it's not. There's Carlos Slim, I believe, has even come out and said that he personally holds BTC on his own balance sheet. So things are changing, and a lot of folks that looked at the digital asset ecosystem as the shady, dodgy super coders and basements are realizing that this sector has been maturing. We're actually getting folks with professionalism, with pedigree, reputation, and experience coming into the boardroom with a lot of the folks across this esteemed stage and some of their panels that we've been hearing from today.
And certainly most dominantly into Bitcoin specifically.
Yes, so let's clarify that. The asset that you should exposure to is Bitcoin, and be very careful about some of the other schemes out there where they're not decentralized, even if they claim to be. Bitcoin is truly decentralized, and we're seeing that become more and more so with the mining operations that are coming up in this region, but also in neighboring countries as well, like Oman.
So price, we're optimistic on the panel. A rising tide lifts all boats. So rising price would be good for all. The other factor that miners consider very closely for their profitability, though, is difficulty, network difficulty. And this is a little more complicated. This is not a situation where a rising tide lifts all boats. For difficulty to go down, that means there's some pain. So Artem, would love to kind of just you gave us an excellent kind of crash course. So why don't you give us a crash course on difficulty adjustments. And the last panel that we had on mining, we were talking a lot about efficiency and efficient miners. So I'd love to kind of develop the discussion in that direction as we think about post-halving, if we don't have that rising tide, or if that difficulty can differentiate those who are going to succeed and those who might suffer.
Yeah, absolutely. So to maintain the block times at 10 minutes, the Bitcoin network adjusts the difficulty that it takes to mine the next block. As more miners start mining Bitcoin, it adds hash rate to the network, which in essence every 2 weeks is the underlying factor why difficulty adjusts up or down. So sometimes difficulty adjusts down, but usually the difficulty is a growing function, right? And roughly, I think difficulty increases on an average of 3% month over month. So nothing is stable in Bitcoin. There's no stable economics in Bitcoin, but we know that difficulty is constantly increasing. And this is really, imagine you're constantly walking uphill and the hill becomes more and more steep with every step you take. So you want to make sure that you're using the best gear, but you're also paying adequately for that hardware. And that's also one of the main strategies. That's part of the mining game, is making sure that the hardware that you're using is efficient enough to beat that difficulty, that block difficulty, because if most of your OPEX goes towards paying electricity rates, and your miners are simply not efficient enough, you're gonna have no choice but to shut down. So that's a transition that happens commonly before each halving. We know that revenue is not going to be the same. The blocks are slashed in half. Bitcoin price is a little bit tougher to predict, but what we know for sure is that difficulty is going to be increasing the more miners on the network, and especially if Bitcoin goes through an appreciation period. We also know that that's going to have a certain impact on difficulty, because since it's economically more profitable to mine the underlying asset, more people join the network as miners. I hope that was clear.
So, Geoff, do you see a likelihood that we see difficulty adjustments to the downside following the halving if we don't see a significant appreciation in price? And what does that practically mean? I mean, what is actually happening when we're seeing that?
Well, just to put a little context to what was just mentioned, generally, the marketplace figured that we would be about 375 exahash by the end of this year. We're already at 450. That uphill climb, as you mentioned it, is there. It's compressing margins. It's causing us constantly to look for how to do things better. And that's what Satoshi wanted when he wrote the Bitcoin protocol at the outset, is that every 4 years this efficiency adjustment would be forced on us. It would flush out the inefficient operations, and only the best would survive. And up until about a week or so ago, I thought this halving was going to be very severe. It still might be. Like at $28,000, $27,000, where Bitcoin was trading for really the last year or so, with the halving, that takes hash price, which is about 7.2 cents right now, but we were about 6 cents down to 3, and we would have all been unprofitable, cash flow negative, and it would have only been the best that would survive. And like, you needed a strong balance sheet and top-notch operations to get through a period of, as I mentioned, about 5.5 months, perhaps longer, given the macro winds that are going on right now. And like, we were preparing for the worst. But we prepared for really the last 3+ years getting ready for this, and we do have a strong balance sheet, and we do have good margins, and our operations are top decile, and we're ready. But then we have like the enthusiasm with these ETFs coming along, and Bitcoin popped to 35, 34.5 right now, and our hash price is 7.3. So we've got some margin again. Maybe it sustains itself, maybe it doesn't, but we're still preparing for some pretty harsh times through the industry. The miners that have older equipment and don't know how to operate them very well, and the miners that have higher electricity contracts, they're gonna be still in a world of hurt, and they may not survive. And that's one of the strategies we had, is that take advantage of these downturns to maybe get some good assets along the way and expand and really add to the company and consolidate. With what's happened with the ETFs, maybe that's going to be a little kinder to miners, but still, with the hash rate march up, 450, we thought maybe 20-25% of the market would come off steam and then capture it back by pretty much the end of next year. Now it's looking more like about 15%. But it's still going to have an impact, and it will flush out some of those old miners. And as we've seen with hardware, they've just introduced some new machines, better efficiency. It's really causing us to think about upgrading our fleets and doing some pretty novel things, and prices have come to more realistic levels. So
you highlighted a few of the factors that go into efficiency. So you're right now predicting potentially, assuming things there aren't major developments between now and the halving, that there's possibly going to be around 15% difficulty adjustment. Miners that are basically have to switch off their machines. The electricity price is too high, or their machines are too old, or some combination thereof. Jaime, would love to hear your perspective on that, or your outlook on potential difficulty adjustments, how those difficulty adjustments reward efficient miners, and what is the definition of an efficient miner? What does that look like today in terms of the price that you're paying for power and the kind of efficiency of the equipment in the portfolio to be in that category that's going to benefit from a potential difficulty adjustment to the downside?
I think we've seen a lot of technological advancement in the last 4 years since the last halving. Software in particular that really allows us to get much more granular on how we adjust the miners for power pricing, for hash rate, based specifically on their efficiency. And that's important. We've seen a lot more creative strategies with miners when it comes to power. More control, miners having more control, better PPAs than we have seen historically. My view is, my personal opinion is that we will see a spot approved before March, and so it is going to change, I think, the dynamic from a traditional cycle, because that's kind of a massive unanticipated event going into the halving, which should allow for better margins post halving than we otherwise would have seen.
Taras, I'm going to play devil's advocate on a point that you made earlier about the decentralization of Bitcoin.
All right, hit me.
So when we're looking at difficulty adjustments, if we see a downward difficulty adjustment, miners switching off, the most inefficient miners.
Yep.
Is that not going to result in the network becoming more concentrated? And are we not seeing the network become more concentrated with the miners that have the ability to access efficiency, scale? We had a discussion earlier today about the fact that retail mining is no longer feasible.
So, great question. What we're seeing right now is that there's a continual hunt for the lowest cost power production on the planet. The diversification of the digital mining sector is actually marching on every day. In fact, at this conference, I was speaking with two groups that are mining in Ethiopia, utilizing some of their underutilized hydro facility power generation. There's other countries in Africa that are just starting to do this, where there's tons of hydropower that's been created and no offtake. And Africa is not the only country or region in the world, where this is occurring. I mean, Northern Europe, this is happening in Latin America. Geoff just came from Latin America because of this very issue, is that there's been a ton of overcapacity on the power generation side that's now found an off-taker of first resort. And because the veil has been lifted that, again, we're not dodgy supercoders, we're actually commodity manufacturers that can actually act professionally, ethically, and be supported by capital markets, I think the diversification on a regional and global basis is going to continue on. To add to the comments earlier around what our miners are going to be doing, is that SunnySide Digital, my company, we work with most of the public companies, the good ones, to make sure that we can provide them assets and hardware at extremely cost competitive pricing. We can also vet new technologies. I mean, I'm proud to announce that we're now working with Rosso Immersion. It's a bleeding edge immersion company that's actually bringing a new type of infrastructure to market that allows existing hardware to be maximized on its use in regards to efficiency, as well as power concentration, driving down infrastructure and OpEx and CapEx costs for miners as they continue to build into the halvening. Because while a lot of folks like to paint the halvening as this terrible situation where you're losing the block reward, what people have been forgetting is that transactional value has actually been increasing on the Bitcoin network. And if you look at that and straight line that as to how much the transaction value is actually increasing per block as a block reward for miners, it's not doom and gloom. You look at what's happening with ordinals, you look at what's happening with smart contract development on the Bitcoin blockchain, and suddenly we're not just beholden to the 6.25 today and then 3.25 later. It's actually going to be a transaction-based network that is sustainable into the future on an economic basis. So there's a lot of things to be really positive about, actually, when you're talking about the halvening.
And to Jeff's point earlier, the pain typically only lasts for 5.5 months. So that little blip then returns as the price runs, and then actually what we see is difficulty starts to ramp up even more quickly in the fall when the bull run starts, because you've got old miners that are being plugged in that were otherwise just sitting idle. But as soon as they become profitable again, they'll find power sources.
So what happens during those 5 months and during the months before? Talking about strategies, talking about how we prepare ourselves. Maybe Artem, you can share what you're seeing as strategies that miners are engaging in to prepare themselves for the halving.
Well, first of all, cash flow management. Bitcoin mining is a cash flow business, so it's really about how you manage it, not over leveraging yourself. This is probably the worst industry in the world to take on too much debt at crazy interest rates. Personally, on the Asic Jungle side, what we've been doing is, first of all, we've been building up a cash position throughout the last bull market, whether from our mining operations or through our brokerage firm, because we understand the cyclicality of the market, and we understand that bear markets last for longer. So if we're imagine you're building a shelter, you're building a house, and you know that winter is coming, you want to make sure you have enough logs, you just don't know how long that winter is going to last. And as Jaime said, obviously patterns repeat themselves until they don't. So obviously having a solid cash position is number one. Number two is we're actually benefiting from the bear market because for those who don't know, ASIC prices and Bitcoin prices are strongly correlated. I think the correlation coefficient is roughly 0.85, which displays tremendous correlation between these two assets. And what we do know is during bear markets, hardware also depreciates. The same miners we were selling 2 years ago, and not because we wanted to, but because that was where the demand was at $100 a terahash, which let's say miner is 90 terahash, so let's say $9,000 per miner. Well, in today's market, they're trading at $3 a terahash. And we know that if Bitcoin appreciates, and the marginal appreciation of the Bitcoin is bigger than the increase in the difficulty curve, those miners will become more profitable. And with demand on miners coming back into the market, those miners will not only generate more revenue, but they will also appreciate in price. So that's another strategy we've been doing. We've been acquiring some older generation miners, which we think will be relevant during the next bull run. And we've essentially built up a cash position to be able to go through the winter.
It's not just cash flow management, it's balance sheet management as well.
Yeah, and people quickly forget how scarce miners can become in a bull run. We were in LA a few weeks ago or a month and a bit ago, and people were asking, how easy is it to get an ASIC, an actual computer server for digital mining in a bull run? And I remember when we were in the last bull run, it was 6 to 9 months to get it directly from the manufacturer because they just didn't have stock.
Well,
So
part of that was
We also had a
chip shortage.
supply chain crisis.
Yeah, part of that was the silicone shortage too.
Yeah.
But, it was a hit. But you need modern fleet. You need to know how to run your machines really, really well. You need a good electricity costs. Electricity represents 85% of your direct costs. Yeah. So the lower you can get electricity, just like Ross said, the better. And that's why we've really taken an active switch down to South America, where there's surplus hydro and natural gas, and away from Quebec, away from some of the northern United States, and putting a more of a portfolio down in South America where costs are lower. So active strategy. We are actively managing this and taking advantage because it's going to be best for our shareholders in the long run. Prepare for the worst, and you will be fine through the downturn and be able to return more to your shareholders in the bull run and the upturn.
We talk about Bitcoin as digital gold, but really what it is digitized energy.
That's right.
And the more we realize that and the market realizes that, I think the better off we'll all be as an industry and industry participants.
And as we continue to evolve and mature, there will be consolidation in the space. And there are technologies out there that allows existing fleets to be upgraded, like Rosso, like the Epic Blockchain UMC board, like the software that Jaime mentioned earlier. So there are ways for existing operations to make themselves more efficient to stay alive.
I don't think we have time for questions, but see.
We're looking at a flashing 00 right
Yeah.
here.
Maybe I can give somebody one question. If no, okay, all right. Really fun panel. Quite informative for everyone in the audience who's thinking about how to look at this sector. That that there is a silver lining to these halving events, but preparing yourselves for it. Managing the balance sheet, managing your power costs, managing your infrastructure. That's why you have the best people in the business running these mining companies and navigating that for you. So thank you very much for joining us on stage.
Thanks, Zach.